Hello active traders and welcome to Swing Scans. This is Ken Calhoun, president of Day Trading University and Trade Master. I wanted to welcome all of my new members as well as our current members back to another fun-filled episode. We're looking at the very strongest of the swing trades. This is the one place in the entire internet where I post my very best swing trading picks. As always, all information is for educational use only. No advice or recommendations about what to buy, sell, or holds being provided. Let me say good morning to everybody for Swing Scans. It's great to see you all here. For those of you who are new to working with me in Swing Scans, let me give you a quick thumbnail sketch of what kind of instruments we look at. Mostly stocks and a couple of ETFs thrown in for a good mix. Most of these are between $20 and $70 a share because that has the most point range and the best trading odds, in my estimation. Minimum 10% range on a 15-day chart. And the reason we want that is you don't want to trade something, say Microsoft or Intel or Yahoo or eBay, where, say, a $30 stock that the low is 30 and the high is 31 or 32, the risk reward isn't good. You want something that has, say, it's a $40 stock that goes from 40 to 44 on a 15-day chart. And it's got a nice range to work with in terms of managing your entries and exits. So in terms of scanning for you, I filter through all the different charts to handpick the very best selected charts that have what I estimate to be the very best odds to work out for you. So volume, at least 1 million shares a day. You can play around with those parameters, but start off with that as we look at what's worth trading. Our main patterns that we look at are 15-day highs, cut breakouts, oftentimes following a 90-day wide range candle move, as well as what I call acceleration ramps. The goal is to see my top 10, or nowadays I'm doing anywhere from 12 to 14 picks each week. Tickers are posted in the members area, and as you can see here, for all of our swingscans.com members, you can log in right now and you can see all the tickers that we'll be going through today with well-explained chart patterns and specific entry prices that I'd suggest you experiment with for paper trading. So we've got 10 main ones. I've got a couple under $20 ones that I add into the mix because I know some of you like trading the cheaper instruments, so I do accommodate and added that as a new feature. And also a couple of the very strongest ETF, exchange traded fund picks. I also highlight last week's movers, and the best movers are in green, the ones that ran up the farthest from the calls from last week. So, and we also look at the sector moves, strongest recent sectors. In this current last week or two, semiconductors and biotechs have been the strongest sectors. So a lot for you in the Swing Scans members area to refer to. So even if you can't make a Saturday live event, the tickers and the specific instruments are listed in the members area. We discuss entry patterns. I want to teach you how to swing trade, so this isn't just a done for you, give you fish. I want to teach you how to fish and teach you the exact patterns that I use in my own swing trades, and hopefully help transfer that so you can learn and start having achieve some level of success in swing trading those patterns when you see them for yourself in each week's markets. We use, again, everything's for paper trading use only. We use 1.5 point or so as a maximum initial and trailing stop, and our exit target is roughly 50% of a 15-day range. So let's go ahead and take a look at a quick example. Let's say you're trading something like this one, CTRP. It's got 44 to 56 as a range. That's a 12-point trading range. Your exit target would be half of that, or 6 points up here. So if you bought, say, 56.50, your exit target would be 62.5. So roughly 50% of the 15-day range is your exit target for a swing trade. You're not going to get the whole range. You should be happy taking 4, 5, 6 points out of a swing. So at least that's how I trade. And just a quick last reminder for those of you who are new to Swing Scans, our rules of conduct. It's not for a lot of Q&A. I can answer a couple of quick questions if you got something. We have an inverse head and shoulders congestion box here. All I care about is, can I buy new highs up at 34 and change and sell it to someone at 37, 38. Anyway, on this chart, the long trigger is 34.8. That's roughly 40 cents above the high on a continuation pattern. Remember, when it comes to swing trades, the best patterns are what I call acceleration ramps, where it goes from a congestion box or preferably a slide uptrend to then take out a 45-degree angle in the last 3 to 5 sessions that on high volume that then likely attracts new buyers on a price spike on a continuation. So to mark that out visually, the best patterns are going to be these, where you've got a minor uptrend that then goes to like a hockey stick. It goes from a minor trend to a sharp angle breakout. That's what I call an acceleration ramp. And this looks like a reasonably strong chart, so we'll take a look at this. For position sizing, I like to scale in roughly every 2 points. So if I bought, I'm looking over at my alerts here for you guys, if I bought 34.8, I'd buy again at 36.8 and 38.8, right? Leg into your trade in small increments that are carefully, intelligently, well thought out, designed to avoid false breakouts in choppy regions and in on the next strength of run on a breakout continuation. So MXIM looks good. Next one, ENDP. What I like about this one, and we'll look at the daily charts too, is we have all these weeks, a whole month or so, of uptrend continuation that continues to take out new highs above all three 50, 100, and 200, 50, 100, and 200 moving average lines. So we've got a reasonably strong uptrend continuation in ENDP. So that's one I would consider looking at for a move. It also has an ascending triangle breakout, if you were to mark that out. It's like a big arrow, right? Anyway, an ascending triangle, usually those, you get a minor false breakout and a pullback, and then if it establishes new highs, then that's the play. So that's why I set the triggers, in this case 74.7, to keep us out of any choppy false breakout between, say, 74 and 74.5 that might occur, and in on the next leg of a run. So ENDP, a good, thoughtful chart there. PPC, another reasonably strong one. I'm seeing a lot of ascending triangle moves here, and that's a classic moves up. Buyers are slowly grinding into it. They're putting on their trades. They're putting their bets on in the market. That's what an ascending triangle is. You've got more long pressure, and that's why they often spike up to new highs once they pierce the resistance trigger area. I still don't want to buy it right at the high because it's likely to do a false breakout. So my long trigger there is 25.6, and again, that's roughly 40 cents above the high. PPC is a gap reversal play. I usually don't like these, but because we have another ascending triangle. This is the week of ascending triangles. So we see a lot of those. Some weeks we have inverse head and shoulders. Some weeks we have just momentum wide range candle breakouts. This last week or two, because the S&P underlying strength has been relatively choppy and indecisive, they've taken their time putting their bets on or putting their size into their positions, so that's reflected in an ascending triangle, right? It looks like classic ascending triangle. If you look that up in a technical analysis book, it looks like that. There's a lot of variance to that, but I want to focus on the simplest and strongest ones with the best charts, right? Let's keep it simple and focused on the best opportunities. So what I'm seeing here is Zulily, the chart, I did a gap down continuation, ascending recovery play. And where's my long triggers? 38.7 in that. I'm a little conservative here. I don't want to get in a false breakout and chop. I want to instead wait for 38.7 for an uptrend continuation if it does fill this gap. My exit target, though, and here's another quick point, looking for roughly 2 points is all. So it's not likely to be a big, huge 8-point win or anything. Likely to do a 50% at best fill of the remaining gap region we have here. See a gap from 46 all the way down to 37 and change. So it's likely to recover at best up to, say, 42. So maybe worth it for a small entry to see if we get a piece of the action there. It might keep drifting up, but I wouldn't be too optimistic. I'd be cautious on along in that one for a gap fill. I usually just like breakout continuations. Can everybody see that's yet another ascending triangle in TMUS? T-Mobile is the chart pattern, and you can see it's done an uptrend, gradually grinding up. These often are good setups for next plays, or the next momentum play is the buying pressure is building, much like a steam kettle is slowly boiling under the surface, kind of like an iceberg and there's all this going on under the surface of the ocean, or a steam kettle is slowly boiling until finally it makes noise. Well, when you see an ascending triangle like this, often they will spike up to new highs. The trick is to stay clear of the false breakout that almost invariably occurs. It gets in, the longer the ascending triangle moves, the more the professional traders, the market makers, the specialists, the hedge fund guys are out there saying, okay, as soon as it pokes its head above resistance, we're all going to collectively sit on the ask, plummet the price back down, so we go short, we cover at a pivot, and then we buy at new highs. And that's where a lot of traders get into trouble, is they buy the first sign of a new high, incorrectly, not wanting to miss the big run, I've got news for you. Typically, that's going to be a false breakout because you're trading against guys like me, mechanics or professionals. So we know how to do this. I'm giving you kind of the stuff they hate me to tell you guys. I know I got institutional traders. They don't want me telling you guys this stuff, but always set a false breakout filter because that's going to get you in unreasonably. Let's say you buy 34.10. As my daughter would say, that probably doesn't end well. It'll probably go up to 34.30, stall out, and then collapse. And then you stop out. And then it runs up to 38 without you, right? Very frustrating. Have you ever, does this sound familiar? It sounds familiar, right? After you've done that a few thousand times, you realize, hey, there's got to be a better way. What's the countermeasure? And that's to set a false breakout filter, as I've taught traders the last 15 years. It's really important. So you'll see, by the way, for those of you who are new to swing scans, is that I've ideally set those false breakout filters are built into your swing scans alert. So 34.6, I eyeball the chart. There is no fixed formula. You can use 30, 40, 50 cents, something like that as a rough rule of thumb, but there's more to it than that. So another good benefit you get. So 34.6, around 60 cents above the high. Now, why do you think with that chart pattern, why am I going to be a little more conservative and wait for 60 cents instead of buying 34.10 or 20? I mean, yeah, there's a false breakout potential. I push the entry trigger even further than, say, 40. Normally, I'd do 34.40 or maybe 34.50. Instead, I use 34.6 as a function of the previous noise in the signal. And here you can see a relatively choppy ascending triangle. We don't have a nice clean move. So I expect more of the same or more choppy noise, and I want to keep us out of any false breakout and in on a continuation move. Okay? So that's the kind of thinking you need to take out as a professional swing trader. I'll tell you, it's the right edge of the chart, the upper right side. How do you stay out of false breakouts and in on those that continue? Okay. TYC, now this one has a better breakout again. It's yet another ascending triangle. That's the nature and the characteristic of most of the charts this week is ascending triangles. So use this as an opportunity to learn how to practice in a safe learning environment, how to set up entry triggers for this series of what I deem to be pretty, and probably 3 or 4 will likely run really nicely. A bunch of the others will just go sideways and maybe chop, but it's the 3 or 4 that do move, the ones you want to learn from, as usual, right? You plant the seeds and water the ones that continue to go up. The ones that don't, you just leave it alone and stay clear. And that's also why these alerts are set up, designed to keep us out of any choppy region and in on a continuation play. So TYC, that's Tyco, right? Yeah, Tyco, 44.20, very conservative entry trigger because of the depth of this pullback. So my deployment is therefore, we don't go in right here, we push it way up there, 44.25 for breakout. And if you look at the daily chart, you can see the reason why, eh? That's right above the previous high. If we were to buy here, that's why we use the 90-day charts. Often, too, for the swing scans, I will go through the 15-day regular course swing trading charts for you, but then I will also pull up the 90-day charts to put it in context, to take a step back and see if there's any major resistance we're going to buy right under and stay clear of that. Instead, park the long trigger just above that to get in on a continuation play. So that's why it makes sense to combine both your 15-day as well as 90-day charts. And I don't second guess by looking at 6-month or yearly charts or 2 or 3 year charts, because then you end up with multiple signals and just confused. So we want to keep it simple. Anyway, so 44.20, that's, hey, dodged a bullet. We don't want to buy right under a previous major cup high, but instead wait just a bit further for it to mature and attract new buyers at a likely inflection point. In this case, would be above the 44 resistance up at, say, 44.25, and that's the trigger point that's likely to then attract the next wave of buyers. Okay, giving you guys complete swing trading training in this. So anyway, I hope that that's helpful. Next up, Southwest. All the airlines have been strong lately. I mean, you can pull up, United, UAL, and Delta. And those are also worth keeping on the radar, but I like Southwest because normally when I trade, I like trading United's been earlier Continental, CAL and UL, but because it has such a strong breakout, this one, notice the inverse head and shoulders here. See how this is a left shoulder pattern? Then a big head, My wife says I have a big head. What's up with that? Just joking. But everyone says I have a big ego, and that's good. Bold traders, that's what it takes, right? You can't be a timid trader. It's like timid salesmen have skinny kids. I think Zig said that. Somebody did. Anyway, timid traders don't go far. So you have to trade, but cautiously. Anyway, do you see the inverse head and shoulders? That's a nice breakout continuation. I really like the Friday price action on this. It had a ascending triangle Thursday, then popped to new highs. See, here's classic ascending triangle, 2-day classic Calhoun breakout. Ascending triangle on the Thursday led to new buyer spike up on Friday. We want to see as swing traders if it's able to gain momentum and continue on up in an upcoming trading session in the week ahead as well. And with Southwest, my trigger's 26.50. So I'm using 50 cents above the nearest whole number. Again, you'll find in your own trades that you are often, if you're like me, you'll find that oftentimes you see what looks to be a good chart, and then you get in at the first sign of a breakout only to get stopped out. And it's, well, hey, it looked good at the time. Why did I take the stop? You'll find that the more maturity, the more experience, the more strategic you make your trading approach, it's much more about careful, cautious entries and fast exits. Not fast, I don't want to miss the big run entries and then a series of stops. You want to instead be much more cautious, and careful. So anyway, that's why I'm using 26.50 and a little cautious on that one. You can experiment with tighter entries, but watch this. Let's see how well these work out next week at the recommended levels. Now here's a gap continuation in Williams Brothers, isn't that one? Williams Companies, okay. Bullish cut breakout, the gap moved up. This has the best uptrend of any of the charts that we've looked at yet, right? No ascending triangle. Instead, this one wasn't plagued by a series of narrower pullbacks. This one has a reasonably strong continuation uptrend. So that's the strongest of the uptrending charts and therefore the best candidate of the bunch so far, WMB. Right? I believe this is one that I had mentioned for you guys last week too. Right, yeah. That was in last week's alerts for you guys, and that one worked out especially well. If you took it, congratulations. Continues to take out new highs with 47 major resistance in our current market. So let's see if WMB, got about 10 minutes left. I'm following the clock here. WMB takes out new highs over 47 in the week ahead as well. It was good last week. Probably still good next week, right? Good uptrend continuation pattern. Volume isn't especially strong lately. I'd rather see volume like this. See these 3 days of high volume? That volume is it's not declining significantly, but it's not what it was during the initial run up. So this one's likely to chop a little bit. Wait until it takes out a new price action high to get in on a continuation play. Another good one, BCE. And I believe oftentimes what I will do for y'all is I will carry over and update the triggers for things that worked out last week that continue to be good candidates for this week, okay? Some of them, they'll hit longs, they'll move up and then stall out and then we don't want to trade it again. Others hit longs and keep running on up like WMB did, and we want to retrade it. If you haven't traded it yet, it's good to paper trade it next week ahead as well, or scale in. You can use the triggers to scale in or add to winning positions as well, okay? So BCE is a nice head and shoulders, inverse head and shoulders right there, right? Left shoulder, head, right shoulder. This is a classic, this is a complete swing trading education online for you guys, in a box, delivered, neatly wrapped and professionally delivered for you so you can see how these things trade. Notice how previous resistance is now new support, right? Classic Trading 101. Previous resistance line becomes new support. I like the fact it poked its head up nicely on Thursday's market. We'll see if it pokes its head up over 46.5 next week. My long trigger on that is 46.8. So that's around 40 cents above the high. Okay, you can see a bearish upper shadow there, pulled back to support, and is starting to bounce. So I like the fact that it's in a new trading range, a new box trading range for it. These are the sequential boxes this thing is traded in. We'll see if it takes out new highs, right? 1, 2, 3. You're familiar with the concept of Darvas boxes, which I urge you to become familiar with. Get the book on Amazon. I think it's $12 by Nikolai Darvas. How I Made $2 Million in the Stock Market back in the 50s. A good box range continuation play. Anyway, BCE, another good one for the week ahead. Next up, FGP. This one's gone from 25 to 27. This is Ferro Gas Partners, whatever that is. Anyway, FGP, I like the fact that it does a bullish cup continuation. It also has a 45-degree angle and separation and breakout continuation play. So we'll see if it takes out new highs over 27 and change. FGP is on the radar, up to bat for the next week ahead as well. Next up, now we're going to look at the cheap under $20 charts. The two best ones I can find for you are these two. IPG is the first one. Again, always give preference to these nice 45-degree high volume continuous breakouts. That's your best odds plays, right? 45-degree angles, no major pullbacks, no lightening up volume, no congestion, and the rest of it. It continues to forge on ahead with an influx of new buyers. So keep an eye on this one. IPG. Again, this doesn't have a huge range. It's 17, kind of a bunny slope for new traders. But anyway, 17 to 18 and change. At least it's taken out new highs. And it has a reasonably strong uptrend continuation. So that's a good, inexpensive one to consider. FLEX, riskier because of these pullbacks and this chop inside the previous box. But it did have a gap continuation, right? Right there. Always be on the lookout as a swing trader. Your single best plays, not this particular pattern. If it were to gap up right there and then continue, that'd be the best pattern. Anyway, something that gaps out of a previous high-low range, telling you institutional traders are that convinced it's going to keep running because they've gapped it out of the previous resistance trigger area, resistance line, and then it attracts new buyers on its uptrend. So this, for a cheap one, it's gone from 9 to 10. Anyway, it's a nice uptrend. The last 2 days has gotten some buyers. So if you trade inexpensive instruments, that's one to look at. Now, let's move on to our ETFs. So you're getting 14 alerts each week now instead of just 10 as we expand. And for those of you who are new to swing scans, welcome aboard. I want you to learn this stuff. Previous resistance, new support. I like XIV. That's one of the better of the ETFs. Its identity. If you're not familiar with this, the velocity shares daily inverse VIX. So typically the VIX is a bear indicator, right? When the VIX goes up, the market goes down. This is an inverse of the VIX. So it's basically a long ETF. It's kind of two double negatives. Minus, you remember your algebra, minus times minus equals a plus. Well, like minus 3 times minus 2 equals plus 6. Anyway, it's a double inverse. Anyway, it's an inverse ETF. Don't overthink it. Anyway, XIV 32 to 30, just under 38. So we've got a 6-point run in this, and it's got a bullish cup continuation play. Previous resistance did provide new support. The minor gap up did attract new buyers. So keep this one on the radar. This is the best ETF chart out there, is XIV, because it is not plagued by any major pullbacks or reversals or congestion regions. It's a nice continuous uptrend. So that's a nice one. The other one here is UCO, right? Our oil. I don't know if oil's doing much. Yeah, oil has the same pattern. Oil, the oil-related instruments. And by the way, this is a good lead indicator, the oil ETFs, for the oil sector. So if you're trading things like Chevron, Exxon, British Petroleum, Antarctica Pete, any of the oil drillers or oil refiners, the ETFs often pick up or capture the underlying directional bias in the small and mid caps as well as the large caps. So the large cap oil instruments aren't doing anything right now, but as a lead indicator, just a quick swing trading, thinking ahead of the crowd, because the oil related ETFs are moving up, they may pick up some volatility. And I personally like trading instruments like British Petroleum at new highs, but currently it's not of interest. I do, however, like my UCO chart, which is the same as the oil chart but has more volume. So a gap continuation, you can see here yet another one of Calhoun's ascending triangle patterns going up to new highs. We'll see if it breaks over 38 in the week ahead as well. So that's yet another swing trade. And right from Krishnan, yeah, XIV is the same as the broad market. So XIV, same as say like the spiders or the Qs, but better. The Qs are reasonably good, but I like the leverage in XIV. So it goes in trend. When I trade the bear ETFs, I trade personally things like XIV, or VXX I should say, and UVXY, those are the bear ETFs, and those go down when the market goes up. The XIV, and Christian's exactly right, the XIV goes up with the broad market. Notice, please, though, if you want to play the market long, I like XIV better than the spiders or the Qs because you have more leverage. It goes 32 to 37 and change. You have 5 points on a $30 instrument, and more importantly, from a trading standpoint, mechanics of the trade is this instrument doesn't have the major pullbacks. Say the spiders do, the Q's a little better, right? They're both uptrend continuations, but XIV is a much stronger one. It's like a string that's been pulled tight, whereas the market ETFs like the spiders and Q's, major pullbacks and tougher to trade. You get stopped out on a pullback or miss a run up and the rest of it. So you always want to trade channeling uptrends like this that have reasonably strong patterns. So that's the best of the ETFs I know out there. XIV. UCO also no slouch, really good for an oil-related ETF. So, it's my sincere hope that you learn how to make a lot of money trading, because we can work together for many years if you can accomplish that, right? So, anyway, thanks for being here. We've got just a few minutes left. Let me know if any questions. If not, let me run through the daily charts just quickly to see which of these. I want to identify which of these are best in a rank order, or tell you which 2 or 3 are best. This one has congestion and big red candle, so okay, but light. And the way you trade that, or the reason I tell you this, is anything less than the strongest charts, I will still trade at new highs, but on lighter share size, maybe 50 shares instead of 100 shares, or 100 shares instead of 300 shares, or whatever the numbers are. So I still trade, but I scale. This has a stronger uptrend continuation. ENDP, right? Nice 45 degree, unlike MXIM, which had all these pullbacks. PPC is a wonderful chart, right? That's one of the strongest charts in the entire stock market. PPC, what's wrong with that? Pilgrim's Pride, nothing much. Even the bullish lower shadow bounced off the 50 EMA, and we got my classic Calhoun bullish cup with the wide range candle at the right that bought in new buyers, running it from 23 to 25. We have a shooting star there, so obviously we don't want to trade it until it breaks clear of that. But PPC, the ticker, long trigger is 25.6. We want to wait till it breaks to new highs. Okay, very good professional thinking on this. Zulily's a bounce, so that's the worst of all the charts, right? We like uptrend continuations. TMUS, bit choppy. TYC, a little choppy. Southwest is good. It's a nice, healthy uptrend continuation. WMB is a rock star chart. That's even better than the earlier ones. It's got a nice continuous uptrend the last month or so. And again, a classic Calhoun wide range candle at the right side of a bull cup that, boom, takes off new highs. So that's a good pattern. BCE, another outstanding chart to look at. That one's good too. I'd go heavy on that one. FGP's another rock star chart. We got a hammer that, it's hammer time, and boom, flawless victory. It goes from 22 to 27. So you got a 5.20% run in this thing. So that's healthy. All right, you always want to trade the best charts. It makes your life easier as a trader. It's like when it comes to dealing with people in the world, you just want to deal with honest, hardworking, sincere people and leave all the trifling, lazy people out of your life, right? Which I did 20 odd years ago. I only work with the best and the brightest, and that's and hopefully present company included, right? I want you guys to all focus on how to actually trade. So anyway, that's a nice uptrend. So that one's strong. XIV, UCO not as good, so XIV is a better chart. WMB looks to be really strong, a nice 45 degree uptrend. So those are the type of thinking, the thought process that you want to take as a trader when you move into your entries and exits. So, okay, well, you guys take care. I'll see you next weekend. Thanks for being here. Bye-bye.